Dividend investing is where you buy stocks of companies with the goal to build an income stream and have the investments appreciate in value over time. Now, you could buy dividend stocks like Coca-Cola, or you could get a dividend fund that has exposure to many companies all within one purchase. But when it comes to this, there are three main dividend investments that I'm about to show you that consist of dividend income, dividend equity, and dividend growth, which I'm about to show you how I plan to utilize each of them going forward. But the simplest way to show the difference between these three investments is generally going to be based off of the amount of dividends that you're going to get paid and the actual growth of the underlying investment. For example, let's just say you get 10% of an annual return from each type of dividend investment. For income, you may see a 6% dividend yield. For equity, it may be a 4% yield. And for growth, let's say 2%. Well, since the annual return includes the dividend yield in the calculation, that means if you were to take the dividends as income instead of reinvesting them back into the fund, that the value for the dividend income investment would only have grown 4% per year, where the equity would be 6% and the growth would be 8%. Now, I completely understand prioritizing growth. I've spent a ton of time researching into this, but depending on your position, each of these investments could be solid options for you. So let's get straight to it and first go over investing into dividend income. So dividend income typically refers to getting a high income off of your investment rather than seeing capital appreciation, which I have to mention, if you don't know what you're doing, you could be in for some serious trouble, because let's say you buy a fund like the Super Dividend US ETF with the ticker of DIV. Well, over the past 10 years, each year the investment averaged roughly a 7% dividend yield, which sounds great, but over the past 10 years, the fund has averaged a 2.1% annual return. And that includes the dividends being reinvested back into the fund. So if you were to take the dividends as income from this fund, then your investment would be averaging roughly a negative 5% return per year. Which means that if you had $1 million invested and took the dividends as income every year, after 10 years, your account would now be at $600,000. So if you are one in the position looking for dividend income, then this is a great example of what to avoid. A better dividend income fund that's only been around for a few years, but maybe one that you're interested in looking into, is the JP Morgan Equity Premium Income ETF JEPI. So with JEPI, it is an actively managed fund that generates income through a combination of selling options and investing into US large cap stocks. The fund pays dividends monthly. It seeks to deliver a portion of the returns associated with the S&P 500, where over the past 12 months, it has achieved a 7.5% dividend yield, which since they officially launched in May of 2020, the fund has averaged a 12.68% annual return when compared to the S&P 500 index at 17.73%. So obviously, if you wanted growth, you would pick the S&P 500. But let's say a 12% return with JEPI subtracted by a 7% dividend yield, that means the investment would have appreciated in value by 5% per year, unlike the Super Dividend ETF DIV that declined 5% per year. And yes, inflation numbers have been out of the roof lately at 4.78 and 4.1% in the years shown, but based on the average inflation rate of 3% historically, JPI's ability to provide a high dividend income while sustaining inflation, to me, currently makes it a solid option to consider. But the thing you need to be aware of if you're someone like me, nowhere near retirement, that dividend income funds like this aren't even in my consideration. The first reason is that I have many years to grow my investments, so I prefer going toward growth than income. So if the S&P 500 can get 5% higher on average, I will gladly take that and not even look at my account. The second reason that's extremely important to understand is that many of these high income funds, they're going to be using hedging strategies in order to provide the income opportunities. So the dividends you're going to earn with them are going to be taxed as non-qualified dividends, which means they're taxed the same way as your ordinary income, which is in the range of 10 to 37%. When compared to qualified dividends that I'm going to show you later in the video that are taxed at the long-term capital gains rate of 0, 15, or 20%. And just so you know, whether you reinvest the dividends back into the investment or you take them as income, with any investments, the dividends you earn, you will be taxed on. Which, just so you know, long-term capital gains are also going to be taxed by the state. So say you're in a state like Alabama, your long-term gains could actually be at 25%, or if you're in Alaska with no state tax, that could be 20%. And so because of these reasons, the best strategy that I plan to use for high income dividend investments like JEPI is to actually invest into growth investments like the S&P 500 in an account like the Roth IRA, where the investments at retirement above the age of 59 and a half are completely tax-free. Where by the time you actually want to take money out of this account, instead of selling shares of the S&P 500 or building up the account using dividend investments for 30 years, I'm planning to just switch the investments to safe dividend income earning opportunities like JPI and another one I'm going to mention at the end of the video that can provide dividends completely tax-free, which in a Roth IRA account, there's not going to be any taxes triggered to actually switch the investments. And say you've been building up this Roth IRA for 30 years at $7,000 per year, which is $580 per month. If you achieved a 10% annual return, you could have over $1 million in the portfolio. And with JEPI getting a 7% dividend yield, that could be $80,000, which is close to $7,000 of tax-free monthly income. And best of all, your $1 million Roth portfolio could sustain growth with inflation and last your entire life providing income instead of dying like the super dividend ETF DIV. Obviously, this is all hypothetical, but I created a video in even more detail, so if you are interested, I'll have that linked in the description below for you. Which, while you're at it, if you find this content helpful, all I ask is that you consider subscribing with notifications on for future content like this. With that said, here's my plan going forward with dividend equity. So dividend equity pretty much refers to companies that have a history of paying strong dividends consistently while still earning solid returns. A great example of this is the Schwab US Dividend Equity ETF that aims to track the Dow Jones US 100 index and comes at a low cost of 0.06% of an expense ratio, where the fund has averaged a 3.21% dividend yield over the past 10 years, which is solid, especially knowing that the fund has averaged an annual return of 11.7%. So even if you were one looking to use the dividends as income, the investment would have still grown roughly 8.5% per year on average. Now, I recently decided to focus more on SCHD in my taxable accounts, and I know it may sound strange, but hear me out. The first reason is that if I were to invest into a high growth fund and try to grow this thing in a taxable account for the next 15 years, let's just say, then I wanted to switch it over into a dividend earning opportunity, that means I'd have to sell it, I'd have to capture gains, then I'd have to use the cash after paying taxes on it to then go buy the dividend fund. Another point to mention is that you have to pay taxes on dividends whether you reinvest them or not. So with an investment like the S&P 500, over the past 10 years, the average dividend yield was 1.55%. So either way, growing this account, you'd still have to pay some sort of taxes on the dividends throughout the years. But I will say it's a nice thing knowing that SCHD can be 100% qualified dividends, which means they'll be taxed as long-term capital gains as long as you hold the fund for more than 60 days in the 121-day period that begins 60 days before the ex-dividend date. Which in the end, if you're taxed even the 15 or 20%, that just means that you're making solid money, and you could even use one of the dividend payments throughout the year to pay for the taxes. So getting into the data, comparing this with the S&P 500, SCHD has achieved an 11.6% return, where the S&P 500 was 13%. Yes, I know that means that you're getting less growth with SCHD. I know I'm young, I'm not near retirement, but here's the primary reason for why I'm starting to actually invest this way. The worst year over the past 10 years for SCHD was down 5.5%, where the S&P 500 was down 18.2%. Another article stated SCHD has historically been about 15% less volatile than the S&P 500. And it's a known thing that stocks that pay dividends typically provide stability to a portfolio and, of course, do not outperform growth stocks. Which, to add on that, SCHD only has an 8% overlap by weight with the S&P 500, which means adding this to your portfolio would diversify your assets even more. Where in Schwab's prospectus that came out in 2024, they stated the criteria for SCHD requires all stocks must have sustained at least 10 years of consecutive dividend payments, have a minimum market cap of $500 million, meet specific liquidity criteria where they must then pass 4 major fundamental characteristics, being their cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. But no single stock can represent more than 4% of the index, and no specific sector can be more than 25%. And even though some of the holdings are actually above 4% currently, Top ones include Lockheed Martin, Coca-Cola, and Home Depot. Where the S&P 500 and many other similar growth funds that you probably have, they are all heavily exposed to companies like Apple, Microsoft, Amazon, Facebook, Google, Tesla, all companies you've heard of. Now, I've spent a ton of time researching and comparing these options, but if you want to see my entire portfolio and how I allocate all of my investments, consider joining the Patreon that I have linked in the description below. But the way I like to view my overall portfolio allocation is that with retirement accounts, I am all for growth in investments like the S&P 500 and other growth funds, because those accounts, I'm not going to be touching the money for many years. So why not have the highest growth potential funds that really, even if they go down in a 5-year economic downturn, I don't care. I'm in it for 30 years. And then for money I could use in the next 10, 20, 30 years, I'm going to allocate some of my investments into SCHD that has low risk, solid returns, great diversification from other growth investments I already have, and then the potential cash flow where I don't ever have to sell the shares just makes it more appealing for me to diversify this with a typical brokerage account. And if the worry is the taxes on the dividends throughout the years, it's at least long-term capital gains. With the S&P 500, you'd still have to pay some in taxes, and if you have to pay that much in taxes, it's because you're actually making that much money. So with the average annual salary across the US being roughly $60,000, if you can find a way to save 10% of your income, which is $500 a month or $125 per week, and you put that into SCHD every month for the next 10 years, say you reinvest now for growth, and by the 10th year, you would have a portfolio worth $109,000, assuming a 3.21% dividend yield, that can make you $3,500 in dividends alone. Or if you kept the same path and did it for 20 years, from $120,000 of contributions, your portfolio could be $433,000 with the ability to provide $14,000 in dividends by the last year. Where if you stuck with the same $500 for 30 years now, your $180,000 total contributions could be at roughly $1.4 million, where the 30th year alone, you can make $45,000 in dividends. Of course, the more you invest every month, the quicker you'll be able to build this type of portfolio. But throughout this time, the worst case scenario is that the economy collapses and you need money. Well, especially being in a taxable account, I'd prefer to include a safer investment like SCHD rather than going all in on the S&P 500. My next video is going to cover my complete investment strategy in more detail, so if you are interested, consider subscribing with notifications on for that video, which I'll have linked in the description of this video once it's posted. But for this type of investing, I'm currently planning to diversify at most 20 to 30% of my investments into SCHD. With that said, the last topic I want to cover is about dividend growth. Now, dividend growth refers to companies that have some income, but more so aims to see strong growth. An investment I like for this would be the Wisdom Tree US Quality Dividend Growth Fund, DGRW, which has averaged roughly a 2% dividend yield over the past 10 years, but has achieved about a 13% average annual return, which is relatively the same as the S&P 500's returns, but with it, you can gain slightly higher dividends and get paid on a monthly basis. The reason I even like this investment is that over the past 10 years, its worst year was -6%, where the S&P 500's was -18%. Please understand that I currently do not invest into DGRW or JEPI right now. But because this has less risk, returns similar to the S&P 500, and pays out the dividends monthly, my plan for DGRW and JEPI and any other strong dividend investments like those that comes up in the future, I would use in my tax-free accounts like the Roth IRA for when I reach retirement and want to have a tax-free dividend income every month. Now, the only drawback I could see someone saying about DGRW is that it has a 0.28% expense ratio, but the expenses that are shown are already included in all the data I just showed you. Please understand that there are many more dividend investments like these that you could choose from, but these three specifically are ones that I see great potential in based off of my research. Don't forget, if you want to see how I allocate my investments, to check out the Patreon I have in the description below. Which, while you're at it, if you are interested to get started with a new platform, the one I use for dividend investing and have linked to a high yield savings account is SoFi, where you can get $25 of free stock when you deposit at least $25. Or if you first want to get their high yield savings account, you could get up to $325 depending on how much you direct deposit. I'll also leave other relevant videos I think could greatly benefit you in the description below of this video. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.